Hi there. Thanks for tuning in. My name is David, and today we'll be doing an analysis and valuation of Calian Group. Now, what is Calian Group? So, just here a little snapshot of them. They're a Canadian company that provides all sorts of services. They've been in existence for more than 40 years. They're quartered in Ottawa, a market cap of 542 million Canadian dollars. They trade in the Toronto Stock Exchange, or if you want to pay some extra fees, you can do it in the US as well, or in the rest of the world. And then generally, their customers are half and half between commercial customers and the government, so either selling to companies B2B or to the government. Their geography is mostly Canadian and a little bit international. About a third of their commerce is international and growing. And they're offering 30% products and 70% services. And here the breakdown on their four sectors, which is learning, advanced technologies, health, and then defense, basically. So there are three growth industries here. Defense with cybersecurity, health services, military equipment, and the training, the space with many similar things here: software engineering, manufacturing, communication products, and then the health sector with digital health services, training, cloud services, cybersecurity. So those are the main industries that will always be growing. Health will always be growing. Defense seems to be growing quite a bit, and space is also a huge, big piece of opportunity. So their track record in general since 2017, look at that, the 15% compounded annual growth rate for revenues, and the EBITDA also with 20%. That's kind of incredible, actually. That's really good performance so far. We love to see that. And they seem to not have that much debt in millions of Canadian dollars, 90 million, and then their cash and cash equivalents is 52 million, which compared to the revenue that they make is really not a worrying number at all. And the amount of cash that they have is nice and it's growing. And then the net debt to EBITDA, well, you see here that they're saying we have a target of 2.5 times, and we actually have 0.4 times net debt to EBITDA. So don't be surprised if in the future their debt load actually grows a little bit. And this should be unsurprising if you see companies that are focusing a lot on this number, on the CAGR. Because what happens if they want to keep growing like that? If analysts expect them to grow a lot, they may want to make acquisitions for other kinds of companies that will help them boost that portfolio. So, in general, net debt to EBITDA has to be at a reasonable level, really. And the only reason why is because in the case of a liquidation, the stockholders actually get paid last. So, you want this number to be lower. So, there's less money to pay out to the debt holders and more money to pay out to the stockholders, really. But below a 3 or 2.5% is fine. And their intentions are very clear here. So if you want a company with zero debt, well, this is not really the company for you. But to me, it still is looking interesting. And here it shows you a really cool breakdown that I wish I could see in more companies when I analyze them. One of them is the organic revenue growth, which does exist, but it does have some years that are rougher and it is obviously lower. Then you have the acquisitive revenue growth, essentially what percentage of revenue growth was through acquisitions. And then you have the total revenue growth. So this combined together, you always see these very strong double digits, which is awesome. And maybe in years where there's less organic revenue growth, they are incentivized to make some acquisitions and whatnot to boost that number. Now, also, after the revenue is generated, well, their gross profit and margin is also growing. The part I really want to focus on here is the margin, especially with companies that acquire a lot of other companies. You should have a really critical eye towards the margins because acquiring new companies is not always easy. It's not always a smooth transition as you have to merge workforces, as you have to standardize processes or convert processes from the previous company to the new company. It can be very tough. But here, where the gross profit margin is actually growing, this shows that they're efficient at acquiring companies and at integrating them. And also that they have learned how to extract more dollars out of producing products, of course. And now their EBITDA margin also growing, not as consistently, but that doesn't matter. The trend is positive. Now, I want to value the Calian group. I'm going to do it in US dollars just for example's sake, but the Canadian dollar conversion can be there. It's almost a 1-to-1 ratio for the Canadian dollar stock and then the internationalized version that I'm going to show. Now, what they have going on here is some revenue growth, which I'm just going to standardize. I'm just going to say they're going to grow revenue at 3% indefinitely, pretty much, from these 2024 numbers. Now, also, I'm going to have a required rate of return of about 11%. That's 1% more per year than the market, and it compounds to be quite a lot over time. I'm also going to divide it by the total number of shares out, and that'll give us a fair value of 40.72 US dollars. If we subtract the net debt, which is 57 million US dollars, which is about 90 million Canadian dollars, then the value post debt is actually $35.87. Now, let's compare this with where the stock is at this moment. Interesting. So we have a value of $31.85 for the stock right now, which is lower than this value post debt, actually. And you should also note that my model had a required rate of return or a perpetual growth rate of 3%, and I'm just rolling with that number, when in reality, they've been growing by these double digits over here in the total revenue growth. So I'm being extra conservative, and yet I'm still getting something where the value is lower than this number. So this is looking incredibly interesting to me. And over the past 5 years, you're probably not the happiest stockholder. It only went up 9% in the past 5 years if you bought at any moment after 2021, pretty much, your stock is negative. So you may not be very happy right now, but it shows you that there's moments where it's smarter to enter, for example, in 2020, and maybe right now, and moments where it's not as smart to enter into this investment. So in general, there's headwinds and tailwinds for this story. So the headwinds are that the Canadian economy has had sluggish growth, and the forecast here from the Bank of Canada is that it's projected to rise about 1.8% in 2025 and 2026, and inflation is going to be around 2%. So decently sluggish growth, especially compared to its neighbor to the south. The Canadian dollar also doesn't have the greatest performance, especially against the strengthening US dollar. And even though most of their commerce is domestic, if they have international commerce, be it in the US or elsewhere, converting that is going to lead to a little bit of trouble with currency conversion. And because they're growing it, we have to note it. And then tariffs, of course. The factor is that tariffs may actually slow the economy down in Canada a little further. That means that their customers that aren't the government, or maybe even the government if they have less tax revenue, may just have less contracts for them, less services that they want to contract for them. So these are things to note. However, the growing Canadian defense expenditure should provide a big boost for the company. Canada has a compromise to eventually spend 2% of their GDP on defense and on NATO, right? And then the international growth can can help greatly with finding greener pastures that are faster growing, can help with finding different acquisitions that also serve different markets, and they're very well positioned for those acquisitions with enough cash and enough debt that they can take out because they have so little. So they can probably take out debt at pretty decent terms. And then their growing margins also show the story of a company that is growing responsibly. So in general, I would say this is a very boring company with potentially very interesting returns. They're boring. Why? Because they just do these services for companies that aren't sexy. They're doing business to business. They're doing government stuff. That's not sexy to the average investor, and yet the returns are potentially incredibly interesting. So even in countries where the economy isn't as stellarly growing as the US or China or some emerging market there, you can still find some gems here and there at the right price. And it seems to me like the Calian Group can be bought at the right price. Right now, it's at these 31.85 US dollars, which is like 45 Canadian dollars or so. And if this was in Canadian dollars, this forecast would be about 51 or so Canadian dollars. So even if you buy it in the Toronto Stock Exchange, it's still overvalued or undervalued to me, rather. So interesting returns here. And it's the first time I've kept a very close eye on a Canadian company other than the Manulife Group a couple of years ago. So I'll be taking a look at this company over time. And I hope we can do an update eventually because I'm incredibly interested in it. Now, I hope you found this helpful. I hope you found this a great example of how there can be many interesting things and many interesting return opportunities, even in different countries. So, with that said, if you want me to analyze any other stocks, please comment down below. Let me know and let me know what you thought of this video. Thank you so much. Don't forget to subscribe and have a great rest of your day.